Well, it's over. No, not the coupon code. That expires tomorrow at midnight. Gosh, no, not yet. We still have time there. The port strike. The port strike is already over. It literally just began October 1st at midnight, which means the 1st, 2nd, 3rd, we didn't even make it a full 3 days. We know that the Biden administration has been heavily involved in negotiations here, and not because the Biden administration is deemed particularly good at negotiating, but rather because, quite frankly, they have to. They can't tell the longshoremen to stop their strike because that would paint the Biden administration and Democrats as anti-union, which that's not going to fly. And instead, somehow, the Maritime Alliance was willing to accept a 62% pay increase for the longshore workers over a 5-year period. My guess is there were some backroom deals, total speculation, that kind of greased the wheels a little bit from some politicians that made it a little easier and palpable for the Maritime Administration to go for this. Because now it looks like a political win for the Biden administration, and the ports are back open and people don't have to go hoard toilet paper again. Because, after all, in the last 72 hours, everybody seemed to think we were going back to COVID. And there were going to be massive supply chain crises. Did actually yield Treasury yields to pop up a good chunk, especially on some of the data that we've been getting on the economy. And I think this is the important next step that we have to pay attention to, because a lot of folks, as we talked about yesterday, had been fearing new waves of inflation. Today, the stock market started selling off when the Biden administration suggested that they were working with Israel and evaluating how to counterstrike Iran. Originally, markets were relieved that it looked like the Biden administration was encouraging Israel not to, but now it actually sounds like they're working with Israel on figuring out how to counterstrike. Obviously, this has led the stock market to fall off, as well as the oil markets to rise. We're at about 77.62 on Brent right now, which is, a little more than 10% where we were at the lows just frankly a month ago, and that could lead to some inflationary pressures. The port strike was another inflationary pressure, but that's gone now, and hopefully the Iranian threat will be gone now as well. Now, unfortunately, we did get other inflationary pressures, though, in, for example, the ISM services report, which isn't great this morning. ISM prices paid came in at 59.4 versus 56, which is certainly hotter than what we had last month at 57.3, an expansion level. They basically just survey companies and say, hey, did you have to pay more for crap this month or less or about the same? So, and then you just average together, 50, 0, or 100. And then the average tells you the aggregate. It doesn't necessarily say how much more companies are paying. So you could have a higher percentage of companies and they're all paying 1% more on an annual basis. Nobody really cares. It's not really inflationary. That's nominal. It's actually below inflationary trend. But the way these surveys are conducted are just, did you pay more or less? And they don't actually get a granular read on, well, how much more did you pay? So you get this inflationary impetus that makes people fear that the second wave of inflation is coming. Now, the ISM Services Index, we got our earlier reads on this. We just this morning, we got the final read for September. We got the flash PMIs for the S&P as well. Those also came in a little bit higher on prices paid, but we already knew that from a couple weeks ago. But the point is, when you combine all three of these, right, the PMIs and the ISMs, that being one, the port strike, and the potential Iranian counterstrike, you get a lot of fear about inflation coming back. And so in the near term right now, if you take a look at inflation break-evens, in other words, inflation expectations, market expectations are that inflation is going to rise again. Right now, inflation break-evens sit at 2.2%, which is pretty much as high as they were right around August 1st, which was right before the whole carry trade disaster. Now, once you remove these catalysts, and you get some new CPI reports like the report we're going to get later this month, I think you'll relax the inflationary tensions again, mostly because I don't really see those as issues. Most of the inflation that we're seeing is either not being properly quantified, like through these ISM reports, or there are these temporary catalysts like geopolitics or a port strike, which is now over, right? So CPI will be out on October 10th, which is Robotaxi Day. And the chief investment officer at Tesla literally just quit to the day 1 week before the Robotaxi event. Topic for a different video, I suppose. I'll just say very, very strange. But anyway, the inflation expectation for CPI month over month is 0.1%, lower than the 0.2 we had last month. CPI core is expected to be 0.2, year over year 2.3, year over year core 3.2. These are very, very low reads. I want to get into the actual survey to see that 0.2. How much are we rounding down? We are rounding down from 0.23. So far we only got 18 estimates. Usually we get somewhere closer to 50 to 60 estimates. So still waiting for some estimates to come in. More estimates actually on the low side of the bell curve, like it's a little bit of a skewed curve. 1.5 more likely for that read for the core month over month than on the high side. So most analysts seem to think it'll come in low. But that's not going to be the catalyst that markets care about right now. What markets care about is going to be that jobs report coming out tomorrow morning. Now, I'll be streaming that, obviously, on the Meet Kevin Market live channel, totally free. You could be there. And that market channel will be covering the non-farm payrolls tomorrow at 5:30 in the morning. The current expectation is that they're going to come in at 150,000, which is good. But remember, the jobs report it's kind of a lagging tool. Really, what you're looking at is what's a leading indicator of jobs. And when you look at companies, for example, this morning we looked at Dave & Buster's, or in our course member live streams, or even just when we look at companies broadly, we see a lot of companies are trying to cut costs by hiring less. You actually even see that in the ISM services report. If you read the report, which I did this morning, and I go through it, they say companies are trimming their workforce by either hiring less, letting people, sort of leave via attrition, and then not refilling those positions, or in some more limited cases, they're actually doing layoffs or quiet layoffs like Amazon. Everybody back to work in the corporate workforce. Please, some of you leave. It'll bump our EPS. This is all intentional, and just shows you sort of the struggles of the economy where, earnings aren't rising as fast as they used to rise, and companies have to figure out, how do we pop up margins? Another example here is this one's a little more extreme, but Spirit Airlines is now in talks with bondholders over a potential bankruptcy filing. This just news within the last couple hours here. And I posted on X a video of Jack, my then 8-year-old, actually doing a fundamental analysis with me of Spirit Airlines. You have to see it. It's absolutely hilarious. You know what? I'll make it easy for you. I'll play it for you in just a moment. Okay, I think it's worth you seeing. But first, I really want to focus on this jobs report and what this jobs report means and what it doesn't mean. First of all, look, the JOLTS and the ADP report, they suggest this jobs report should be fine. So I think Treasury yields have already reflected that this is probably going to be either an at expectations or above jobs report. But we haven't gotten the QCEW payroll revisions, and we won't for quite a while. Remember, we got the revisions through March in August. Okay, that's 5 months later to actually get the revisions. You're not going to get the revisions, for example, for September, for what, until, 5 more months after that period. So sometime February, March of next year. It's kind of crazy. So Jay Powell already recognizes this. And what he recognizes is that the labor market is more likely to be a leading indicator of economic distress, not through the jobs report, but rather through anecdotal evidence. They actually stated themselves that they find anecdotal evidence is more important than jobs reports, even though the jobs report's going to be important tomorrow. The market's going to trade on it. Don't get me wrong. The market's going to move like crazy on it. But they look at anecdotal data. And so when they see this ISM report that says, ISM services employment comes in at 48.1 in contraction once again, 3 months in a row now in contraction, that's something they're paying attention to. And when they see Challenger job cuts higher than expected, when they see the Challenger jobs report that's as terrible as it was, these are things that concern JPOW. Remember the 3 warnings he gave us? I actually put together a list of these sort of recessionary indicators over at ehack.com. But anyway, he gave us 3 really important warnings. One of the warnings was that the labor market better predicts recessions than GDP. 2 is that we have to consider the revisions take a while to come in. We already covered those discussions. But then, he also gave us this weird pause about, is 50 going to lead to a soft landing? And I think it really evidences his concerns over the labor market. So this jobs report, I don't put a lot of credit on this jobs report, even though I know the markets are going to trade like crazy on it. Here's what it takes for me to really go bullish. For me to really go bullish, I have to see these earnings. First of all, we got to get rid of these other stresses. We already know that. We get rid of these other stresses, but then we see earnings for companies. And I don't really care about Q3 earnings. I care about guidance. And if all of the companies report and they all say, we're growing so much, we're back to hiring, we're back to hiring, we're back to hiring, we're back to hiring, fantastic. In September, I don't know what it is, but in September, it is very common seasonally to see a pop-up in the jobs report, in the JOLTS report for job openings. It seems to be regularly in September, you get these pop-ups. But my concern is that, after you got this in anticipation potentially of port strike, temporary hiring or long-term hiring or new orders or whatever, so you have the stock before the port strike. I realize now the port strike is over. But now, did you pull forward a bunch of demand artificially to September, and now you potentially go into a hole right before the election? And then what is that going to do for layoff plans going forward into January? Not generally so much November, December, maybe, but people want to get through the holiday season of spending, and then come the layoffs. So I don't think we're out of the woods. And my take also is that when you look at someone like a BCA Research, this is the same company that told us that investor ability to allocate cash right now is at record lows, households and investment firms, that most of money markets are really just like companies that have access to that capital. But take a look at this. They say a recession is imminent and favored tech stocks set to crater like the Nifty 50 did. All right, well, that might be a little parabolic and extreme, but it's okay. I'm gonna simplify this a little bit because I'm simply gonna start with, hey, the coupon expires tomorrow, right? Go check it out, meetkevin.com. You get my course member live stream analysis, and we get to do Q&A together. It's really awesome. Check it out before the coupon expires at 11:59 p.m. I always add value to it as well, and the goal is that anytime you have a question about something, you can always hit me up in those course member live streams. We love chatting there every day. Thank you, by the way, Jeff, I see, just signed up for the Platinum membership. Kenneth signed up, Todd, Timothy, thank you so much for joining up. Appreciate a lot of you. And then all the others of you who've joined in the last day or so here. Thank you so much. Okay, so let's get into, remember, you get lifetime access there, you pay once, and you're in forever. It's a great deal over at meetkevin.com. A recession is imminent and favored. Okay, what do they say here? The rise and fall of the Nifty 50 stocks in the 70s is a cautionary tale for investors in the Magnificent Seven craze. The Nifty 50 referred to basically a bunch of stocks that generated some pretty crazy returns. Magnificent Seven may not be the reincarnation of the Nifty 50, but investors can learn from past manias and panics. And they're referring to what's happening right now with a cautionary tale and warning of groupthink, suggesting that, quite frankly, a lot of these companies, specifically paying attention to NVIDIA, have gotten a little too rich. They say that the 1970s phenomenon might not be the exact blueprint of what's to come, but when you combine index weightings, regulatory scrutiny, where things sit with valuations, and where the economy sits right now, they seem to be very bearish, especially since they think and have expectations for an imminent recession. Now, I just want to be very clear about my take on recession. I think that if we don't have a shock in October, the odds of a recession do fall. If we don't have a shock by February, maybe March 1st, we've probably stuck a soft landing. So one of the problems that I have as an investor, and I think it's always important for everybody to sort of look at themselves and say, hey, like, what's your problem when it comes to investing? One of the problems that I have is I see trends very early, and I just get in very early. And then sometimes they still have a hard time to get through. And then they do really well, right? I'm not guaranteeing or saying that it's always like that. I'm just saying sometimes, it's like, all right, you bought the dip, and it's like, oh, it keeps dipping. That just happens sometimes as an investor. And then it comes up and you're like, oh, okay. Yeah, I didn't get the perfect bottom there, but whew. And so this is where, as much as I've said on the channel that I've been getting more bullish because of these trends and new orders, I also want to be careful to consider this pull forward of demand. And I have absolutely no idea how much this pull forward of demand to make sure that companies have enough supply and inventory before the holiday season occurred relative to other years, to where some of the data we might be getting for September might be really skewed, and it's artificially making the economy look stronger than it is. Now, I'm not trying to sound like a bear, because I feel like you could say that all the time. It's like, oh, the data's good? Well, it must be wrong then. Like, I feel like that just sounds like a jaded person, but we knew this port strike was coming since June. And I think a lot of companies saw this being a really big problem. 50% of goods and services coming into the country held up by these port strikes. And, port strike, the workers are going back to work on Friday. So you'll have, 5 down days or whatever. And they are only pausing until January. And then I think they want to keep negotiating. But because they have an agreement and, so far in place, it does seem like they'll go back to work full speed ahead. But anyway, what I'm most concerned about is, what if the recession does indeed occur, but it happens a little bit later than expected? As in, right now, markets seem to be convinced that the market's going to go straight up after the election, because quite frankly, it usually does. Okay, cool. So what happens if everybody bought before the election, and then after the election, people are like, what does this mean? And the market sells off towards the end of the year as people take profits or do whatever. I have no idea. That's all like crystal ball stuff. But at some point, the risk is layoffs. And the trend for companies, the leading trend for companies, is less hiring, not more. And so while the jobs report tomorrow is important, I don't think it fully can make me a bull. Now, if we get a really good jobs report beginning of November, and we get really good guidance from companies, in other words, we get the Q3 earnings, and then companies are like, man, Q4 is looking great already. Because remember, we're already in Q4, right? So most of the earnings are going to happen, 2 or 3 weeks, 4 weeks, 2 to 5 weeks into the fourth quarter. So they'll be asked on the earnings call, hey, how are the consumers doing? How's macro doing? How's the economy doing? And if they're like, it's kind of like the summer, we're getting worse, I'm going to be bearish. Right now I'm probably like a 4.1 on the bear bull scale. If these earnings come out and they're like, dude, this is way better than the summer. We don't know what happened in the summer, but everything's better. Inflation's down. We're selling more. This is great. Might officially be time to flip. So, and trust me, I really want to flip. I want to be really honest with you. When you're a bull, everybody loves you because you're telling everybody how everything's going to go up. When you're a bull and everything's going down, everybody loves you too because you're telling them it's okay. But when you're a bear, everybody hates you when things are going up because you're the contrarian. And when things are going down, people hate you because you're making money and they're losing money. So it's extremely difficult to be a bear. I just can't help myself. You could look at my list of recessionary indicators over at ehack.com. I've got them all broken down. Anyway, I did promise to show you the Jack video clip, so I'm going to do that after I just quickly mention, if you are interested in wealth consulting, what we think we've come up with is a better phrase: wealth strategist and financial concierge. That's like a long title. We got to think of a better name. Maybe you could leave a comment with a better one. But wealth strategist and financial concierge, that's kind of what we think we are. And we think that because we do so much more than just advise about equities. I mean, right, like today, I've been going back and forth with the team about people, and they own businesses, or, they have social media brands, or they have products companies, or they want to sell a company, or they want to sell lot, or they want to deal with a code problem, or whatever, like all of these things in conjunction with like trying to solve all of these with taxes and stock allocations and diversification, retirement. There's so much. And so we're really engaged in all of this, and we're really enjoying this. So thank you to those of you who have signed up over at stockhack.com. And the name needs to probably be something more encompassing, but oh well. Anyway, go check that out at stockhack.com if you're interested in it. Set up a free intro call to see if the service is right for you. And with that said, let's take a listen to the amazing Jack and his commentary on Spirit Airlines, which is now going BK. And I'll hide myself while we do it. Do you know who Spirit is? Wait, Jack, tell us. Who's Spirit?
Very bad airline.
Why? What makes it very bad?
It just is.
It just is? Okay. Yeah. What color are the planes?
Yellow.
Wow. Okay. All right. Okay. Well, let's see. You want to see if they make money?
I already know they don't.
How do you know that?
YouTube.
You. Let's find out for sure. Operating revenues. So how much money they brought in, okay? Let's take a look at this. Operating revenues right here. See that number?
Mm-hmm.
So that's in thousands, which means you actually have to add like 3 digits to this. Isn't that kind of crazy? So do you know what kind of number that is right there? That's how much money they brought in. And like tickets and selling food and stuff like that.
Is it 1,250? Huh? I don't get that number.
Yeah, it's a pretty big number, man. So that's 1,000 right there. That's million. That's billion.
So they make $1 billion?
They collected $1.2 billion. Do you know how much they spent? Let's find out.
All of it.
All of it. Dude, you're a comedian, man. Jack, you're wrong. They didn't spend all of it. They spent that much.
Wait, what's the number above it then? Wait, isn't that higher?
Yes. Now, if only we had Jack in charge instead of the politicians, they might actually have a balanced budget. Anyway, thanks so much for being here. Good luck, everyone. Good luck tomorrow on the Jobs Report. See y'all soon. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.